All right, bring in Tom Hayes, our next guest, chairman and also managing member of Great Hill Capital. Joining us live out in New York, my great colleague Will Kalouris is also part of this conversation. Tom, good to see you and appreciate your time. First off, I was going to start with Twitter and Elon Musk and sort of the sexy stuff. Let's get both out of the way. Rounded out the earnings season for the big financials. Consumer, I mean, the iBanking side, I think that was no surprise there. The consumer, very strong. Their CFO is saying, look, they saw the strongest or highest consumer spend in a quarter ever. Is that being hopeful, or what does it tell you?
Well, there's no question the consumer is strong. We heard from Brian Moynihan that was very positive for the market. What we saw, Martin, was the credit quality increased. Their net loan charge-offs dropped by 52%. So while you saw the banks, kind of a profit slump with tough comps on last year, with Bank of America down 12%, on the profit side, JP Morgan down 42%, Wells Fargo down 21%. You had all of them beat on the bottom line with the exception of JP Morgan because of the reserves they took for inflation and for Ukraine. And you had all of them beat on the top line except for Wells Fargo and JP Morgan. But I think what Brian Moynihan laid out, which is a consumer bank, yes, the deal fees were down. We saw that in Citi. We saw that in Goldman. We saw that in JP Morgan. But the consumer is strong. So those consumer-centric banks, I think, are going to be okay here. And we're seeing that yield curve re-steepen in the last couple of weeks since the 210 inversion.
Yeah, indeed. We're sloping the right way now, or the normal way, as it were. You know, at the beginning of the earnings season, people have been looking at financials and thinking that maybe this is going to be a repeat of Q1 last year, exactly a year ago, in the sense that because of the volatility, trading revenues are going to save them. Was that the case?
Yeah, I think it certainly was. In the case of Goldman Sachs and JP Morgan and Citi, it offset the increased expenses, the labor expenses, et cetera. So that was a very positive thing for the banks. The other thing that was positive for the banks is tremendously low expectations. I mean, all of these stocks, the entire group, was trading down dramatically into earnings. It still had some weakness after the first few reported last week, but I think Bank of America kind of puts a lid on it and says these stocks have gotten cheap enough here. They're probably due for a bounce. You saw Wells Fargo say as rates go up, we'll make more money, et cetera. And I think that people are going to start to give them the benefit of the doubt. We could certainly see a bounce in that group moving forward. But you do have to consider that the fact that the yield curve did in fact invert, Martin, and that is a pretty good indicator of recession. I think that the bad news is we're likely to get a shallow recession because the consumer is so strong. Shallow recession in 2023, maybe late 2023. The good news is the stock market can rally a lot more beforehand because despite what most people think that when the yield curve inverts, you get an immediate recession, the case is it's usually a year and a half out, and the stock market tends to have its steepest gains over that period before the recession. So there's a lot of opportunity and things to do in the market.
And it would have to be selective, though, because if you're looking in terms of your risk-free rates and the price multiples that we are seeing right now on the S&P, you're looking at around about 19.5, pushing towards 20 times. But realistically, when you've got the 10-year continuing on this upward track, you would think that the calculations of the risk-free in terms of the CAPM is going to drive some of the equities down. So is it more about finding or being selective and in terms of what you are looking for over the course of the year in the run-up to what you're suggesting? And if so, where are you putting your money?
Unquestionably, Will. I think you nailed it. I think it's putting it in perspective. So we saw the 10-year yield up to 288. I think it settled out at 285 today. But think about the last couple of peaks. In October 2018, the 10-year got up to 325. In January of 2014, the 10-year peaked out at 303. And many of these groups did well. So you've seen a massive sell-off in some of the innovation stocks, in some of the interest rate sensitive to long duration earnings. But what you're seeing is an excessive crowding in Q1 into cyclicals, into commodities. You know, many of these commodity stocks and banks in particular up 100, 200, 300% off the pandemic lows. And now everyone's crowding into them and they're dumping tech, they're dumping innovative tech, value tech. And one group that we like in particular is biotech. Biotech has a low correlation to GDP growth. And while we had GDP growth of 5.9% in 2021. It's going to be much lower, still above trend, probably 3.5 to 3.8% in 2022. And we want to start to look to those sectors that have sold off in the fear of the hikes. And now that we're getting the hikes, that can perform in a slowing GDP environment and possibly a mild recession environment in 2023. And that's why we like biotech. If you look at biotech, if you look at the average multiples of this sector since 1986, first off, the sector's corrected 50%. It did the exact same thing ahead of the last tightening cycle from 2016 to 2018. So it corrected in 2015 in anticipation. We saw in 2021, the last few months, correcting in anticipation of tightening. In the subsequent 2 years, from 2016 to 2018, while the Fed was tightening, the sector appreciated 140%. Right now, after this crash that we've just had, 50%, the sector would have to appreciate 24% to get back to its average price to book multiple since 1986, 155% to get back to its average price to operating cash flow, and 112% to get to its average forward PE multiple. You've got 16% of the components of the XBI, which is a biotech equal weighted ETF in the US, trading at 2 times cash on the balance sheet. Many are trading at a discount to cash, and it's the lowest price to sales in over a decade.
And that's probably going to be good news for Cathie Wood as well. But speaking of something that a lot of people are paying attention to, what do you make of what's been happening with Twitter? Elon's coming with that 54-20 bid. The board's playing a little bit of shenanigans with their own nod to 420 when it does come to the poison pill. But realistically, at that kind of evaluation, or perhaps a little bit more, should they just be saying yes in order to maximise shareholder value?
There's no question, but you have the principal agent problem. I mean, they have a cushy setup. Most of them are Jack Dorsey, don't own any stock. They get $200,000-$300,000 to show up 4 times a year, and they don't want to give that up, and that's understandable. But I think when you get a 6 handle in front of that bid, they're going to have no choice as fiduciaries, and they'll have personal liability if they reject it to not take that type of a deal. And with Apollo coming to bear after the close, there were rumors that the private equity group could be a financier for Elon Musk. I think we do get a 6 handle, and maybe if push comes to shove, given Elon's comedic nature, maybe it gets up to 64-20. But I don't know if he's going to go that high. If he did go in that range, that's probably the number he'd come to.
Yeah, talking about comedic talent, we were actually joking whether or not it might actually go up to 69, but we'll leave that for another day. So in other case, look, what you're basically saying is Apollo and Musk is going to drive the offer to 60, 65, and there's absolutely no way that the Twitter board is going to not be able to say yes to that.
That's correct. Listen, this board, they've delivered zero value for shareholders since the IPO. So that's a tough track record right there. Number one, they have fiduciary liability there, delivering zero value since the IPO. And then number two, when you get up to that range of 60, 63, maybe 64, I don't know if Musk will go that high, but anything with the 6 handle, they have to seriously consider that and probably take it, turn around the company. And I think if there's someone that can turn it around, it would be Elon Musk, attract a lot of influential people that haven't been engaging, that haven't been tweeting, to get back on the platform, to become active and draw in a lot of monthly active users that have been dying.
Maybe even Alex Jones and Donald Trump, who knows? But anyway.
Speaking of tech, Thomas, as well, I can't let this slide. I'm looking at some of your notes, and in terms of Alibaba, we've seen an absolute smashing of a lot of these China ADRs over the course of the last 12 months. You're incredibly bullish on Alibaba. Now, in terms of the justification, I can understand that because of the depressed share price, the potential that they do have for growth in terms of the runway. But realistically, with so much risk on the regulatory side and what we have just seen over the course of the last 6 months when it comes to the policy standpoint of the China CCP, do you think that they can see that similar kind of growth that you are suggesting when it comes to Microsoft back in 2014? Because at every stage, every day, if you're an investor, you're looking at putting your money into Alibaba, it could all just go up in smoke.
Yeah, well, Will, the number one job of a politician, whether it's in China, in Chandigarh or Sheboygan, is to stay in office. And what you're seeing across the board with big China tech is 20% layoffs across the board. This is a common practice before every China National Congress every 5 years. The next one is, as you know, is happening in November. The year before, which would be 2021 in this case, they crack down, they assert the communist authority over business, they do regulation, they realize a year ahead of the event that they've overshot, people are getting laid off, they're becoming unwieldy, unhappy, and then what happens is they reverse course. They slow down the regulatory crackdown. We saw that video gamers, they started to approve licenses in the last couple of weeks. And what happens is massive stimulus, both monetary and fiscal. China is the only developed country in the world right now that is aggressively easing, and they have been since November. Now, there are two issues why we're not seeing that in a material way now. Number one, the shutdowns have offset that in the short term. And number two, it takes us six to 9 months, just like tightening takes about a year to slow down the economy. Stimulus takes 4 to 6 months to be felt in the economy. So as these Shanghai lockdowns start to lighten up, you're going to see it. I mean, and in effect, we did see it with the GDP was a bit of a shock. The industrial production was a bit of an upside shock. Retail sales, you have to understand, people are locked in their house. They don't have income. They're gonna spend less. But once that reopens, I think we're gonna see things really accelerate. And the big are gonna get bigger. It's the unintended consequence of regulation that the smaller players won't be able to last. The bigger players are actually gonna gain share. And as you saw with unemployment, expectations at 5.5%, it jumped up to 5.8%. That is not a good thing going into the China National Congress if you want to have a smooth transition of power.
Tom, real quickly, the Hang Seng, historically, every time it's traded below book, it has rallied big time. You think it's set to do the same now?
No question about it. You know, it's trading at a discount to book or just about book right now. In 1998, it traded at a discount to book, the Hang Seng. In the next 17 months, it was up 156%. It did it again in 2008. The next 21 months, it was up 110%. 2016, it was up 82% in the next 23 months. And in 2020, it was up 36% in the next 11 months. So every time it gets this low, you get a reversion to the mean. It always looks darkest before dawn. That's exactly what we're experiencing right now with China tech, with the regulatory noise. But that stimulus is going to kick in. They're going to gain share. Their consumers going to come back strong. Yep. And you're going to look at this as a generational buy opportunity. When we're looking out 12 to 24 months, people are going to look back and say, I wish I had at least put a flyer on this and taken advantage of that opportunity.
Wow. Generational buy. Sounds like, the sun rises in the east, huh? Listen, Tom, great to talk to you. Appreciate the time. You keep safe. We'll do it again very, very soon. Tom Hayes, Great Hill Capital, plus Will Cloris.